Annualized return of Bitcoin is 140% a year since 2012. You can own any VC fund, you can have any other asset class, nothing comes close. 20 million% returns since 2012, 20 million%. Since I started Real Vision, Bitcoin is 450,000% returns, and we started talking about it. But ETH came a cycle later, a couple of cycles later actually. Well, ETH is about 160 something percent, 165% returns annualized. Been around less. Solana, 200% returns annualized because it's been around less, earlier on the network effect. I don't know if you can get your heads around this. And if you're not a crypto investor, I simply don't understand.
Prepare yourself for an impressive adventure with Real Vision and Global Macro Investors visionary founder and CEO, Raoul Pal. Pal is a well-regarded macro analyst and passionate cryptocurrency lover. His unwavering optimism regarding cryptocurrency assets and technical stocks positions him as a leader in the financial industry. According to him, cryptocurrency offers retail investors a never-before-seen level of development and empowerment, in addition to acting as a buffer against the depreciation of fiat currencies. Pal has a highly bullish. He makes the audacious prediction that by 2025, the total value of the cryptocurrency industry will rise to an astronomical $12 trillion, perhaps tripling the present worth. He thinks that this increase will push the values of various cryptocurrencies to new all-time highs, with Solana targeting $11,000, Ethereum going for $8,000, and Bitcoin looking for a startling $200,000. Come explore Pal's latest predictions and insights with us as we discover his fascinating story about the future of the cryptocurrency market through 2024 and beyond. We'll examine Pal's perceptive approach and shrewd forecasts through exclusive footage from his most recent interview, giving you important insights and viewpoints to negotiate the volatile world of cryptocurrency investing.
So given that all assets are driven by debasement, everything is basically driven by the business cycle, and everything is correlated. Some things lead, crypto and technology lead. As the business cycle bottoms, so ISM comes across 50, commodities and cyclical plays come into play. There are some lagged things that come behind, real estate and stuff. But anyway, business cycle rules it all. Everything's highly correlated. It's all driven by the everything code. So the dirty secret is this is the easiest fucking game in the world. You just divide all the asset prices by each other, look for the best performing asset. So that's what I did, and that's what I uncovered, and that's what changed everything about me. As you know, I've been involved in crypto since 2012, but I really started to realize that if I divide S&P by cryptos down 99.98%, if I divide gold by Bitcoin down 99.99%, if I divide oil stocks, if I divide emerging markets, if I divide world equities, 99.9%, they're all down since 2012 versus Bitcoin. And technology, the secular bull market that's made everybody a fortune, down 99.93%. Right. So everything goes down 99.9% over time versus crypto. But it's not over that, 10 years time horizon, 12 years time horizon. Actually, when you look at it, crypto is the best performing asset in the world, 3 out of 4 years. Fourth year, it's the worst performing asset. Then it's the best performing for 3 years. Then it's the worst performing. This keeps going on. Bitcoin, even with 3 or 4, 80% drawdowns-ish, 75, whatever the average is, still has done about 140% a year returns. Let me just repeat that. Annualized return of Bitcoin is 140% a year since 2012. You can own any VC fund, you can have any other asset class, nothing comes in close. 20 million% returns since 2012, 20 million%. Since I started Real Vision, Bitcoin is 450,000% returns, and we started talking about it. But ETH came a cycle later, a couple of cycles later actually. Well, ETH is about 160 something percent, 165% returns annualized. Been around less. Solana, 200% returns annualized because it's been around less, earlier on the network effect. I don't know if you can get your heads around this. And if you're not a crypto investor, I simply don't understand why, when you've got the best performing asset class of all time, the fastest adoption of any technology in all time outside of AI, the largest generation of and fastest generation of wealth in the shortest period of time, why you'd not be involved? It's just bananas to me. It's a scam. All you're doing is helping yourself disappoint your future self, right? An asset is future deferred consumption later. And you want your assets to be worth as much as possible because you're taking risk with that money by locking it up. So therefore you should be compensated for that risk. Your future self will go, well done, Raoul. 10 years ago, 15 years ago, you bought this stupid thing called Bitcoin and it's now up 20 million%. Thank you, that's great. I can go out and go and buy a house or go on a world cruise or buy a mega yacht. So anyway, that's what I got to. And it's not because I'm like this singular focus, Bitcoin or blockchain or crypto is everything. It's because it is everything.
Raoul Pal has talked a lot on the strong and indisputable relationship between business cycles, the world money supply, and asset values in recent interviews and social media posts. His most recent thesis, The Everything Code, explores this relationship in great detail and what it means for investors who want to successfully manage the markets. According to Pal, investors may more precisely time their market moves by being aware of this association. Pal's study indicates that the liquidity cycle normally happens every 3.5 years, with sporadic slowdowns that are usually linked to recessions in the economy in between. Based on his experience as a macro strategist, Pal predicts that central banks are preparing to start printing money again and argues that we hit the cycle's bottom in October of last year. The former Goldman Sachs executive lays forth 3 main arguments in this video that show why central banks are about to resume creating money. He goes into further detail on how these moves will probably lead to a notable increase in the cost of cryptocurrency assets and other financial instruments. Pal's observations clarify the intricate relationship between asset prices, economic cycles, and monetary policy, providing investors with insightful advice on how to navigate the ever-changing financial world of today.
At the phase where the Bitcoin halving is happening, the election cycle where they give out free candy to the kids, stimulus, and we generally get, well, we've got the central bank who want to cut rates, even though inflation's not playing that game. We'll talk a bit about that in a sec. And then we've got global stimulus cycle from the weekly global liquidity index, which has been rising. So this is the part where liquidity starts going up significantly. The Europeans are going to start cutting. We've already seen, I think, the Swiss cut. We're going to see a few nations cut. Latin America that was first to hike started cutting. Brazil. So we'll see the cutting cycle, global cutting cycle will pick up. We've got China with a very lackluster economy. In fact, it's a debt deflationary trap driven by an aging population and excess debt. We all know about those things because we're all living in one, whether we're living in Europe or living in the US or Japan. So they're going to stimulate more. The Japanese are pretending to raise rates, but they've still running kind of negative interest rate policies when you look at it in real terms. And we should see inflation continuing to slowly decline. Now it's been flatlining for a while, but many of you have seen me tweet out a chart of previous inflation cycles versus this one. It always has this flat bit, then it hooks down. If I look at the Trueflation index, the guys at Trueflation have this real-time inflation index with millions of prices. That thing is now at 1.78%. It's falling. I know nobody believes me. Either way, the Federal Reserve want to cut rates. Why? Because of the Everything Code. I've told you about the Everything Code. If you've not seen it before, please watch the YouTube videos on the Everything Code. The Everything Code basically suggests that they have to use liquidity to monetize the interest payments on the debt. We're coming into the teeth of the interest payments now, and we're paying for the interest for the debt we issued during the pandemic. So we got a lot of payments to do. The bond market's freaking out from this, obviously, because they're like, how can we pay for all of this stuff at 5.5% rates without issuing more and more and more debt? Gold market's breaking out on the back of this, and so it should be, because the answer is going to be they're going to have to use liquidity. Will they use quantitative easing? Probably not. Why? Because we all know the trick, and we know the name quantitative easing equals money printer goes brr. So what will they do? Well, they've been running down the reverse repo. That's okay. It doesn't matter what the format is, but they've been running down that, which means banks have been putting money into the market. Then they have been they're still doing quantitative tightening, but they're already talking about, well, at some point we need to stop that. Of course they do, because the reverse repo is almost empty. That runs the Fed out of opportunities at this point. Next part is, what do the Treasury do? Because the Fed is basically just helping the Treasury now. Well, the Treasury's been building up the Treasury General account. That's their bank account. And then what they will do is start running that down over the election, which is liquidity flushing into the system. We've got to get through, I think, Mike Howell talks about this. We've got tax season, and often that takes money out of the money markets, and then it goes into the Treasury general account, then it gets drawn down. Some people think that's liquidity negative. I'm not entirely sure. I think, but in the end, the Treasury general account will be like $1 trillion, and they'll inject that $1 trillion nicely back into our hands, and number go up. And then all the other nations around the world were doing something similar. Then we've got probably Basel IV, which is next year. Basel IV is even tighter standards that means that the banks have to use more regulatory capital, which means they need to own more bonds. Clever that, right? Find a way for the banks to own all the bonds so you can keep issuing them. Okay, they're all doing that. So that's about to happen, rolls out in, I think it's the UK first or Europe first in like January. And then, I think the UK's following the US, which is July. And I think Europe's in January. So we've got that whole liquidity event to come. Then we've got, oh no, the commercial real estate market. The banks are stuck with this. What do we do? Oh my God. Let's absorb it onto our balance sheet.
Raoul Pal offers a thorough analysis of the state of the economy today, emphasizing significant variables that will influence market dynamics. First, he highlights the convergence of events, such as the halving of Bitcoin, the election cycle characterized by stimulus packages, and the increasing trend in the global liquidity index. Together, these indicators point to a stage in which liquidity is dramatically increasing. Pal highlights the global trend of central banks reducing interest rates, a development motivated by a number of economic facts. He points out that countries such as Switzerland and those in Latin America have already started reducing interest rates, and China is also anticipated to boost its economy despite obstacles including an elderly population and high debt. Pal also talks about the subtle strategy used by nations like Japan, where nominal rate increases are combined with real negative interest rate policies. He admits that although inflation has not increased much, signs like the real-time inflation index point to a slowdown. Pal presents the idea of the everything code, which emphasizes the need for cash to finance debt interest payments in light of these changes. He emphasizes the Federal Reserve's propensity to lower interest rates in order to address the growing burden of debt, especially in light of the spending cuts prompted by the financial crisis. Pal believes that because of its perceived inflationary effects, there may be a move away from quantitative easing, with more popular alternatives including the running down of the reverse repo and the use of the Treasury general account. He believes that the market will see an infusion of liquidity due to things like tax season and Basel IV requirements, which force banks to keep more bonds since they have to adhere to higher criteria. Pal concludes by outlining a number of upcoming liquidity events, including as the adoption of Basel IV and the depletion of the Treasury general account, as well as the issues that the commercial real estate sector will soon face. His observations offer important background for comprehending how the economy is changing and what that means for investors.